This is a special podcast presentation from 700WLW.com. This is Casey Boland on Demand.
And joined now by Casey Boland of Hanghold Capital Management. We talk money about this time of the morning. And Casey, a few years back, you point out banks were taking away home equity lines of credit. Number one, why was that? And number two, why are they coming back?
Well, with the financial crisis, at that point in time, financial institutions were scared for their lives, so they ratcheted down how much you could then get your hands on as far as funds. Mm-hmm. And so taking away home equity lines was very common back then. Now today, because of the great housing market and home prices improving and a good economy, well, credit lines are much more readily available.
Yeah. And one of the things you say to watch out for, if you're somebody who's you or as a household, you've run up a fair amount of credit card debt. There's a temptation on the part of some people to maybe use the home equity loan to pay off credit card debt.
Definitely. I mean, when you look at interest rates on most credit cards are anywhere from 12% to 19%. And when you look at home equity lines, those rates are going to be anywhere from 4 to 8% in most cases. So, wow, I mean, it's so attractive to be able to roll that credit card debt in because not only it's a lower rate, but in home equity lines, they allow you to pay interest only for several years. So let's say your monthly payment on a $20,000 credit card balance, it maybe was $300 to $400 a month. Now that minimum monthly payment is going to be $100 on an interest-only loan with a home equity line, so it's very, very attractive.
Well, it is. You have a lot more cash flow, but there are problems.
Yeah, I mean, you've got the improved cash flow, but you might be tempted to spend more now because now you've got improved cash flow that you can use in other things. So it's important to make sure that you would use that to aggressively pay down debt. And now you get back to the real problem of why did you get all the debt in the first place, and that's overspending. In many cases, people have not dealt with that underlying issue, and it can be very easy to start ramping up that debt again.
Another issue is not paying off the credit card debt won't put your house at risk, but the home equity not being paid off can.
That's right. I mean, that's the biggest risk now because if you default on unsecured credit card debt, that's not going to put your home at risk. But once you roll that credit card debt now into the home equity line, defaulting on that home equity line of credit could cause you to lose your home. So be very careful. If you're considering consolidating credit card debt into your home equity, you need to solve the issue of the overspending and how you're dealing with credit.